Alright guys, welcome to the next video of this section, and in this video we're going to discuss what a sponsored candle is. And this is probably this concept and the inefficiency concept are probably the two most important concepts in this course, because if you understand those two concepts, you understand structure, you can build a plan around that, and you're set. Literally, you're set. So please pay attention to this. Like, this is probably one of the most important videos in the course. And so before I actually show you examples and just how to understand and find them, I got to tell you what they are first, right? So let's go back to the first video of this section, and we discussed what, basically the pyramid of where we are in the market, where major banks are in the market, and where, the algorithm is in the market. And so obviously algorithm is number one. That's how we determine macro bias. That's who manages and creates price and reprices price. But what we have to understand is, yes, major banks do have the power to move the market, and they have that ability because, like, as we discussed, we said that they have the money, the liquidity, basically the money to do that, basically those actions. And what we have to understand is that every time liquidity is pushed very strongly in one direction, a lot of the times it could be quote unquote manipulation from major banks, and that's what they get sued for, etc., etc., etc. But that's not the point. The point is that when you see those spikes in liquidity, that's how you basically quote unquote find the footprints that they leave behind. And essentially what a sponsored candle is the remnant of that, right? Is basically what's left over in actions like those. So when we're looking at sponsored candles, I want you to write down all these rules. I'll probably include them in the description of this video, but first off, it can be a candle that, for one, takes any type of liquidity, and by liquidity I mean any low, any high, any any equal high, any equal low, or it mitigates a previous SC, and I'm going to show you an example of that here in a few. And then rule number two is you have a violent or a semi-violent move in the opposite direction after that candle has closed, right? And that's usually, essentially, it could be anywhere in a range, whether it's in the edges or right in the middle, right? Any random downside candle to the upside in an upside move, there could be potential there, etc., etc. And also, this is probably the major rule when it comes to an SC, and that is that the amount of body in comparison to the amount of wick in that candle has to favor the side of the body. And what do I mean by that is, like, if there's a lot of wick, for example, yes, this pushed down and gave reaction to the upside, but this candle here would not be considered an SC because look at how fat this wick is, right? So let's get into the examples just so I can emphasize on that, because that's probably the most important rule, is you have to understand that the volume is inside of the actual body, right? All these time frames, all they're meant to do is represent to you the same data that's already present. So we want to maneuver through these time frames to find the candle that best suits us, right? And I'm going to show you this example with this at the end, but here we can get started with the examples. So example number one, right? This is weekly time frame, right? So we see a trading range, and then we see one random wick, and notice that this random wick is connected to the open of this quote unquote SC candle. So what makes this SC valid here? Well, for one, it has a violent move to the upside as soon as the closure. Two, it took out these three previous wicks, which means there's liquidity sitting under these wicks, and it took out that liquidity before it went off, right? And for three is, look at how much volume is in here, and you can judge that based off of the fact that there's so much more body than there is wick, right? And therefore the process of price coming down, coming back into those orders, and then coming to the opposite side, that's called mitigation. Right, that all that means is that those orders that were used to push price down were basically recovered and closed at break even, so that then we can move to the upside, right? So example number two, right? This is a more cleaner example, right? So here, this follows that one rule, right? That we have a downside move and then a violent move to the upside as soon as right after that happened. So that just shows that, there's potentially money there, and that liquidity has to be covered for through the process of mitigation. And as soon as that candle hits, right, you see that little wick here at the next candle next to the actual SC. With all of that is connected, but I use this time frame just because it gave me the most body and the least amount of wick, right? So notice this wick took out these two indecision candles here, meaning it took out some type of liquidity before taking off. So that validates this as C, right? And as you can see, price impulse to the upside, corrected down, right? And then now we have one candle that pushes price down into the 50% of this candle and then gave the opposite move. Now, why did we use the 50% here? Well, let's think about it like this, right? All of the volume is inside the body of the candle, right? So when we're thinking about this, right, I don't know if you guys have ever used different brokers, but I use a ton of different brokers, and each and every broker has a different pricing, whether it's, the difference is a couple pipettes, maybe even a pip, right? Well, if that's the case for us, when you're looking at bank liquidity feeds, each one of them has different pricing as well, because they're getting their prices from different locations, right? So the reason why we use 50% is just because it's the actual average, right? We're assuming that that's the average of the amount of orders and liquidity that are in there, right? Will it always hit 50%? No, but it's the most optimal because our stops are usually right below the candle closure or at the closure itself. So that gives you a massive risk to reward, right? So as you can see, we got 50% here, right? And then here, right, we had this new formed SC because this SC mitigated a previous candle and then gave an eruption to the upside, right? And now notice structure is bullish. So price came back down and it mitigated only the open this time, right? Which is why you should always be aware of both the open and the 50%, right? So now this candle's been mitigated, and then now notice it never came back because now all the orders have been sufficiently cleared. So now instead of there being any type of sell side movement, you're going to see upside movement, right? And if you can master those simple tips there, then this is easy going for any of you, And here is example number 3, right? So this is actually NZD USD, not AUD USD. And as you can see, right, we had plenty of opportunity in this scenario. And it's either we can catch the bottom, maybe there is a candle to the left, right, that this potentially mitigated, right? We then have a reaction to the upside, and it's very violent in my opinion because it engulfed almost 2 previous data candles, right? And as you can see, this is H4, so that's that's a lot of data essentially. So as you can see, right, that next H4 candle right after the actual full reaction, it came back, it mitigated this open and then reacted to the upside. So now that is our new area of interest. So as you can see, price gave forward, came back, mitigated open, right? This is mitigation set number 2, and then that's when it gave the full reaction, right? So as you can see, this, just by eyeballing this is already 9, 10 to 1, 11 to 1, 12 to 1, and that's exactly what you want from these markets, right? So now we're going to look at something that is more so in time and basically in real time. This is actually maybe 2-3 weeks ago from the recording of this video. And this move was a total of 900, but it even went up to 1150 pips, and this could still even continue just because of how corrective the structure looks. But anyways, you're asking me, why am I using this random orange zone here, right? Well, like I said, price does not understand time and vice versa, right? So what does that actually mean? Like I said, this is all these time frames are representations of the same data that's provided for you, which means that there is 2 different dimensions that we're messing with here. and that is time and price. So once you understand that they don't actually influence each other, they just correlate to each other, that shows you that there is no real time frame. There is no proper time frame you should use. Use all of them. As you can see, 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, etc. 30 minute, 40 minute, 45 minute, 20 minute. Like, who uses 20 minute? It's like, why not? You know, like, why not? Right? 2 month, 3 month, 16 hour, 12 hour. You know, all of these are relevant because what you're looking for is a candle that follows the specific rules that you want, right? So now if we start zooming into this 2 hour candle, 1 hour, what do we see? Still, that's too much wick, right? Not enough body. 45 minute, same thing, too much wick. 40 minute, too much wick. 30 minute, cool. Now what do we see here? Right, as you can see, volume came in out of nowhere, right? And as you can see, this previous high here was taken, right? Thanks to this candle here. So now our zone, right, is at the open and 50%. 50% there. Right, didn't reach 50%, reached our open. That's fine. This is still what, a little range of 13 pips, right? Let's say you have your position at the open, 13 pip stop loss, right? And then now let's say you ride this to the floor, right? Obviously we're looking at a massive swing here, but just look at the potential that you have. This right now, that's already 68 to 1, right? And I haven't even shown you guys how we actually enter the market. We don't have to necessarily enter from this. There's entry techniques that can minimize that stop so much more. But just even by just following this simple rule, if you hold this trade out for, what is this? How much is this? Let's say you hold it for less than 2 weeks, that's 70% on account. If you risk 1%, of course, right? So that's exactly what you want to see. And imagine if you cut this stop loss in half, because somehow you get an entry on 1 minute time frame, 2 minute time frame, seconds time frame, right? That just multiplies. Look at that, 116 to 1. 116% on one trade is absolutely insane, right? Will that happen every trade? Of course not. But the point is that these, if you understand these candles fully, you have the potential to essentially multiply accounts with proper management, proper risk management, and less trading. This is one trade that you obviously hold for 2 weeks, but who's to say this won't keep falling? And who's to say you got an even better entry than that, right? You're looking at 200, 300, 400, 500 to 1 trades if you're able to hold. And then now the issue wouldn't be your technicals, it would be your psychology, right? So just take that into account. It's all about the candles. It's all about the wicks. It's all in the wicks. It's literally all in the wicks, right? People say, you know, wicks tell you stories, blah, blah, blah. Yes, they do, if you zoom into them and you can actually interpret what's going on. So just remember the rules, right? I'll probably include them in the description of this video. So yeah, guys, next video is probably inefficiencies and just how those work.